Brian and Bo were using a lot of language that is only applicable to universal life insurance.
Dan Flanscha, he is not new to this game. He's practically been in this profession for over 40 years.
If you were to go buy term insurance, that same level of coverage for a 30-year-old would cost $4,000 a year.
Brian and Bo are wrong, as most of the world is. I had to step back and say to myself, I don't even know what they're evaluating. And I'm going to say it could be further from the truth.
If you do that, all the numbers get smaller. It actually looks worse.
They really don't understand the whole premise behind infinite banking. They should not be giving any life insurance advice.
All right, ladies and gentlemen, we got a treat for you today. We're going to be reacting to the Money Guy show, Insurance Companies Are Lying to You, Infinite Banking Exposed, which has over 88,000 views on the Money Guy show. I did a reaction a while ago, got less views, I think 15,000 and counting. Now, for those of you that don't know Dan Flanscha, he is not new to this game. He's practically been in this profession for over 40 years or coming up on 40 years, right around 40 years. You are an adjunct professor at the American College. So you teach some of the highest professionals out there when it comes to our profession. You are currently a CFP, a CLU, a CHFC, and an RICP, which is my fancy way of saying you have the alphabet soup behind you.
Which
which just means that you've been in the space longer than I've been alive. You have many designations. You not only are aware of the American College, but you've been an adjunct professor in it. We originally connected at my life insurance event. You're working on some interesting research, which I won't spoil, but it's like, wow, you're working on some things that are really meaty, and I'm grateful for you taking the time to come to the studio. So before we jump in, you have 9 points. We've taken 7 hours of content. We've taken it to 9 points. And I told Dan, we're going to have to move this thing along. Yes. All right. So before we jump into that, what was your initial reaction when you watched their video, maybe my response, like without giving some of these points away? What was your initial reaction to the Money Guy show? Because I can only speak of like them on a personal level from what I see from, how they treat their families, their communities, their churches. Incredible humans, 10 out of 10 human beings. They are amazing people. But we're not talking about that. We're only going to criticize what they've put on public domain around insurance. And you're not just an insurance person. You're also an investment person. We've done a lot of talking, just you and me talking about how really it would be a shame not to integrate them together.
Yes.
And so I thought you would be a very, very good person to bring in and hear your critique, maybe your challenge, and who knows, you might get in trouble for this video. So
I'm sure I will. Everything's debatable. Right?
So without further, I told you you'll get criticized from people that you won't even see their faces, but people will comment. So without further ado, I'll hand it over to you.
Well, I know the purpose of this right now is we want to just tantalize, why would someone engage in this? And I know you've asked me too, why would you get on a plane and come to Nashville? I think it is, Caleb, I have a passion for teaching. And I have a lot of respect for you, and I think this is another media, so to speak, where through you I can help or will be able to help with this to help educate. Now, you got to want to educate yourself. So yes, we've spent a lot of time recording, and I think it's been fun.
It's been great.
It's been a long time, but it's been fun.
Yeah.
So the reality is we've got plenty of meat for you,
Yep.
but you'd have to commit some time and energy to learning. And I think you can use my years of experience, my formal and informal education and readings and study, and glean from it. So you don't have to spend thousands of hours learning. You can do it in several hours.
I think that's a great example. 7 hours is a lot of time, but it's all relative. You've spent a lot more than 7 hours with all the research, and you've been so kind to instill it, literally doing PowerPoint presentation, handouts, and it's a form of leverage. We're leveraging the blood, sweat, and tears that you put into understanding all these topics, and you broke it down in a very simple way. And so for that, thank you. What was your take on the Money Guy show and their take on insurance And because they both have credentials,
Yes.
they're probably one of the biggest platforms and one of the most respected platforms on YouTube when it comes to the money space. And they have a lot of really, really good takes. This take, though, being in the insurance space, I politely pushed back. I made some points, and I had more views in my average video, and I think people resonated with that. And obviously, there's always people that will push back. Your take, you're not on the content world. You don't come from that space, but you have a lot more experience. What was your initial thoughts when you watched their video for the first time?
Now, we're going to cover this in videos, but I just take it at face value, and you'll understand why if you spend some time and devote to it here. My initial reaction is I wouldn't have expected anything more from them.
Okay, so you weren't shocked. Nothing that they mentioned.
Absolutely
like
nothing.
three. Okay.
Why? Because they're coming from what I'm going to call the CFP world. And that leads right into my first point.
Okay.
When I saw their credentials when the video first started, we've got a CPA, a chartered financial analyst. I knew right away where they're going to come from, because to me, we have two camps that operate in this world when it comes to the financial world. We have the insurance silo and we have the investment silo. And very seldom do I see both of them working together. So the reality is they come from an investment silo. I wouldn't have expected anything more from them.
I see. So, okay. So point number one is, and we did a whole breakdown together, but you summarize that really clearly. There's an investment silo, an insurance silo. They should be best friends, really.
Oh, absolutely.
And yet the reality is a lot of insurance people are trying to undermine investments to sell more insurance. And a lot of investment people take the high road and say, I'm a fiduciary. Don't buy anything with commissions. And you're going to get a better net worth. And we even broke down, they're not necessarily wrong, but net worth doesn't always translate into the results you're looking for. Anything that you want to say more about the silos, or should we go into point number two?
Just this is that I started in the insurance silo, but very quickly also moved into having a foot in that investment silo. In fact, it was only 1 year after I started. So the reality is I've been playing in that sandbox, so to speak, for 38 years in the investment. I think what's happened, what I observe here, Brian and Bo, the money guys, they grew up or they got their start in the investment silo. They just haven't taken the time and energy to start digging into the insurance silo.
What would be your 30-second commercial to why someone who's in the investment silo should care about the insurance silo?
Efficiencies. You can get better results with less risk. Things will work in more than one circumstances. You don't have to be lucky depend on rate of returns if you start blending the two silos together. And we could go on and on with that. I think that's well said. That's just leave it at that.
All right. Point number two.
It has to do with fees and commissions. And I believe that the insurance industry has been maimed by society. The society has been misled about the fairness of commissions on, I'm going to say, life insurance products. So on the one hand, we criticize that, but on the other hand, we don't really talk about the expense of investments and the impact that's also having on someone's financial well-being. So we're going to share a quote with you here from Brian and Bo, and then we address this right up front. And I think the reality is, again, if you include both silos, you're going to get a much better overall efficient financial plan at less cost. So here's the quote.
Fees and commissions can be very high for whole life insurance. If you're buying low-cost index funds, the internal operating expenses are super, super low.
All right, before we get to point number three, when we were sitting down, you actually did a scenario where you did a buy term and invest the difference scenario, and then you did an integration of investing and converting to whole life as they go on. And shocker, the year one, obviously the insurance was a higher when it comes to cost, but over a 30-year time period, the buy term invest the difference, actually you ended up paying way more, assuming an assets under management fee, than what you would in the insurance and investments. Now, that's not even a great point, because you should do whatever best for your family. Right. So it's a bad talking point to begin with, attacking how someone gets paid. But the irony is, it's pretty clear. If you look out over time, just because you're getting paid on a commission doesn't mean you're getting paid more over that time. In fact, a lot of times assets under management and people that have that style of business end up getting paid a lot more than you would on the insurance side. So it's irony at its finest.
Yes, I would agree.
All right. Point number 3.
One of the things that we're going to get into is evaluating whether Brian and Bo are actually talking and evaluating whole life insurance or universal life insurance. Now, infinite banking, which is what they were evaluating, is all based on the premise of using the product or the tool of whole life insurance. And yet Brian and Bo were using a lot of language that is only applicable to universal life insurance. So when I got to that part of the video, I had to step back and say to myself, I don't even know what they're evaluating. Now, I couldn't see the illustration in front of them. I had seen it for 5 seconds, I would have known, but from their language, I had no idea. So we're going to have a little fun with this. And what we're going to do is we're going to share a montage, if you will, of language that they use that is only applicable to universal life, and it doesn't even apply to whole life. So we'll let you hear it.
The costs and fees of the policy are going to be greater, or the rate of return they're willing to give you through the dividend rate is going to be lower. Fees and expenses can eat into your return. Nothing we've talked about right now actually covers the mortality expense fees or the commissions that are paid on these types of policies. Surrender fees typically don't go away until you've had the policy for at least 10 to 15 years.
Surrender fee is going to eat you alive because a lot of the initial premiums is going towards commissions and other things. So there's going to be a steep surrender fee. Cash value is actually going to be paying the much higher cost of insurance. Am I reading this right?
Yeah, that's right.
How do you get past the surrender fee?
You call this Alcatraz. If putting your money in a 401k is putting it in prison, putting in this feels like you're putting in Alcatraz.
Yeah, and that's net of fees and all the other things that are coming through.
There are fees coming through, and then a portion of that every single year, every single month is paying for the insurance. So fees and commissions can be very high.
The reason I think this is important is obviously if someone has a platform to communicate their message, they have an opportunity in front of them. I think this is a caution for us. If you're going to get into a topic, you better know your material. In fact, it takes some research, and that's why I also think it's important, and I spent some time, we did today, I wanted to introduce folks to the concept of Austrian economics. You can't really understand where IBC, infinite banking, is coming from unless you understand where Austrian economics is coming from. Brian and Bo had every opportunity to dig into this, even about learning the differences between whole life and universal life, but it appears they didn't invest the time and energy to do that.
Yeah, there's a common theme when people really go down the rabbit hole when it comes to insurance. And I'm not talking people selling, like people that want insurance in their life. A lot of times it is a lot of philosophical aspects meeting math that create that conviction, which is very interesting. Let's go to point number 4.
At least with the investing, buy term, invest the difference, you at least now get to have the assets and then use the assets, and then your heirs get the assets later. Yep. You don't have to die to get the higher number.
Yep.
All right. You heard it said that basically if we take an investment approach, at least what you're going to have is the assets. We assume from the language that that also means those assets are going to produce the retirement income, and at least you'll have the assets to pass on to the next generation. Now, if you want to assure that all of those things are going to take place with an investment portfolio, I can assure you it is going to come at a high cost in terms of what income it will produce for you in retirement. And we're going to break that down, and we're going to back it by research. So using that research, we're going to show you how you can produce a much higher amount of income in retirement and leave a larger legacy in some circumstances by combining investments with other insurance-based products. And I'm going to tell you this, and this is your tantalizer, it can mean 50% more income if in retirement if you're incorporating insurance tools. That's worth spending some time learning about.
Yeah, that video in itself is going to get a lot of people interested. But what we did was you looked at investment only, and you looked at the day before retirement, the day after retirement, and the day after death.
Mhm.
So these are like the three aspects. And so obviously the investment only side usually was always ahead the day before retirement,
Yes.
meaning from a net worth standpoint,
Yep.
the person that had investments versus the person that had investments and insurance, if you just looked at the day and all you cared about was that net worth number, they're ahead. But then you looked at what income that you could provide in making sure that you're not running out of money.
Yes.
So we're creating almost like the same type of risk when it comes to running out of money. And almost every scenario, the good, the bad, the ugly, with the assumptions with how investments worked, you had more income with the insurance space. So that alone is interesting, and I think we could talk a lot more. And if I ever do get the opportunity to sit down with Ryan and Bo, I would love to just hear their thoughts around that, around like their pushback. But then when it comes to legacy, there were times where the investment only created a greater legacy, and there are more times with the insurance created a greater legacy as well. And so if all you cared about was polling someone, everyone would choose the more money before. So everyone would choose before retirement, they would choose this on a street, like 10 out of 10 people. If you just showed them the income, I think 10 out of 10 people would choose probably the insurance and investments. And then if you showed them the legacy, majority of people would choose the insurance. And so it's interesting because net worth, other than making you feel good by looking at the number, what does it actually matter? It should be what can help me create more income. And so that is a big part. We broke it down, but that's a part that gets overlooked by so many people, and they're comparing it to an investment. They're not necessarily comparing it to an overall efficiency when it comes to how money works.
So I'm going to use this one phrase. He who ends up with the biggest pot of money at the end of the rainbow, meaning the day before retirement, wins the game. And I'm going to say it could be further from the truth.
Right. Okay, let's go to point number 5.
All right. Again, I think it would be most appropriate in this case, let's let Brian and Bo make their comments and then we'll respond.
If you look at how much insurance coverage costs, and this is for a female in excellent health for a $500,000 policy. If you were going to go buy term insurance, it would cost her $188 at the age of 30. That same level of coverage for a 30-year-old would cost $4,000 a year. So $4,000 versus $188. Fast forward to a 50-year-old female in excellent health. If that lady wanted to buy a $500,000 policy, she's going to spend about $644 a month for that term coverage. If instead she wanted that same amount of coverage in whole life insurance, it's going to cost over $9,400 a year. So these are very different when it comes to costs of getting that insurance coverage in play.
They are absolutely correct. There is a difference when it comes to the price. The price of whole life insurance is much more than the price of term insurance. So I want to give them credit. That is categorically true. However, it's very important to break down not only price, but cost. And we will test cost over different project timeframes, which you've alluded to. Is it at retirement? Is it when death occurs? But the reality is when we consider lost opportunity costs, which is an entirely different subject, the reality is they do exist. We can come to that agreement, right?
Yes.
Just like gravity exists, but you can't see it, lost opportunity costs also exist. And the reality is, Brian and Bo are wrong, as most of the world is. The true cost, when factoring in lost opportunity costs, the cost of term insurance is dramatically higher than the cost of whole life insurance.
And in my way of summarizing that is, if you don't die during the time period, which statistically says you won't, and I hope for your sake you don't, then every dollar that you paid into premiums don't benefit you at all.
At all.
Now, to be fair, they create a benefit of peace of mind while you're alive,
Sure.
But from a financial standpoint, it's money that's gone, and it's not just the money that you spent, but it's the money of what it could have earned. And I don't know if this is going to be one of your points, but it's interesting to me that they use the examples they use is super preferred female.
Yeah.
Okay, which we showed that is like only 4% of the population would check that box, and so the even the numbers they're using for their example is like pretty crazily skewed because their whole life example, they're not necessarily giving the top 4% whole life example in their exam. Like, you know what I'm saying? So they're like cherry picking a term cost scenario and not necessarily doing the same thing on the whole life. But if we just put that aside, or whether it's, I think it was $188 a year or whatever that is, it's not just you're losing out, but then the death benefit you lose as well. And so that doesn't just have a cost today, but every year that goes by has a cost that you'll never be able to recapture.
To defend Brian and Bo, I do think they use the same rating class on the whole life.
Okay.
So they were being consistent there. And also, to be fair to Brian and Bo, everybody uses that same technique.
Right.
They always pick the highest underrating class. In reality, it statistically just doesn't normally happen.
It's like all the commercials that say you could get life insurance for $1 a day, and it's like they're always going to assume the best case scenario. Okay.
Okay.
Most people have no idea where to start or how to really evaluate whole life insurance. That's why we've built The Vault. It's all of our best life insurance resources and educational tools all in one place, all for free. We have calculators, handbooks, crash course, deep dive videos on numbers. If you want to learn more, click the link in the description or tag comment below to unlock The Vault. All right, back to the video. Point number 6.
Well, it kind of reiterates something we've already talked about as a side subject, but it's driving home this point about how permanent life insurance can help us with retirement planning. And it's not only just life insurance, it's the inclusion of other insurance-based products. Because in these two silos, we have the investment side, which is basically centered around risk. On the insurance side, we have products that are manufactured to provide guarantees. It's only natural that we probably could assume over time in most circumstances, our rate of return is going to be higher on the risk products, right? But the reality is, because of those guarantees, if we leverage them, we can again come up with a better overall, more efficient retirement plan that produces more income. And who's in the business of risk management?
Insurance companies.
Insurance companies. And what main risk are they dealing with?
Your life.
Mortality.
Yeah,
yes, it's
expectancy.
your life.
Yep.
And so they have that ability scientifically to provide those benefits. And this is well ironed out.
Yep.
This is not a new game to them. They have the ability to offer those guarantees. And that's where we can utilize them to help us in our overall planning.
And this is something that we didn't have to actually talk about in our 7 hours together so far, but we insure our homes, we insure our cars, we insure, we do health insurance. And that's one of those things would be like, yeah, of course, some of the times we need to. It's like you're required, but even if you weren't required, any reasonable person would say, yeah, could I self-insure my home? Yes.
Yes.
Can you self-insure your car? Yes. Can you self-insure your health insurance? Sure, even though it probably is illegal. But the reality is any person that is like looking at it from an efficiency standpoint, if I'm going to self-insure my home, now I'm going to have money tied up that won't be able to be used in any other place if I'm truly going to self-insure. And if I'm going to self-insure other areas, now I'm being less efficient. So if we get that, like I think majority of people understand that concept. But then why do we know we're going to die. We know that's going to happen. And yet we're like, oh, permanent life insurance is super expensive. Like, and we almost don't like factor in like, okay, if we know something's going to happen, we go to a company that helps us pool the risk. Like, wouldn't logic say like we should look into seeing if that would? I know I'm just verbally processing right now, but like, do you kind of understand what I'm trying to?
Well, let me build on that a little bit. These other types of insurance are all if insurance.
Yeah, this is a when insurance.
This is a when insurance, and what's so ironic is the one thing that we know is going to happen. It's just a matter of when. Why we fight back so much about putting that protection in place. And I think it gets back somewhat to selfishness. We know that we're not going to be the beneficiaries of the death benefit. However, I think we're going to give, in the recordings that we've done today, ample ample ammunition, so to speak, of how you're going to take advantage of that death benefit while you're still alive.
Yep, I love it.
Okay.
All right, let's go to point number 7.
All right. On this one, let me set the stage for this, and then we'll play a couple of snippets. By the way, these snippets are throughout the video, and if you watch it in its entirety, I would encourage you to also be watching for these. But basically what Brian and Bo are doing is they're positioning themselves to approach this product with no understanding of what it's about from a standpoint of infinite banking. They're approaching this product as though they're being very unbiased about it. They're neutral. And they make statements about, well, we could have done this, but we didn't. We want to give it the best picture possible. So that's all fine and dandy. But we're going to start to do is break that down. They are not being unbiased in their evaluation. And I want people to understand that and be able to see that as well. You can even pick it up in their voice inflection. And if we learn to recognize these things, I think it also helps us as consumers. So with that in mind, let's play the video.
So the whole point of infinite banking, of banking on yourself, is that I can use myself as a bank instead of having to use the bank. Well, if you do that, all the numbers get smaller. They go down, they get lower. So if you actually use this strategy the way that it was designed to be used, it actually looks worse.
All right, so let's hit a couple of things where they're missing the boat and they're not treating it unbiased. First of all, they talk about borrowing against the contract. Now, if you pay interest on the loan all the time, you don't affect its performance at all. So that would be one point, is you can't just say, well, we're treating it and giving it the most favorable light. So borrowing has to do with it. And we'll get into others as we dig into the video. But I want you to understand what it boils back down to is they really don't understand the whole premise behind infinite banking.
Yeah, infinite banking. And again, to be fair, it's not necessarily their space. They're not in it, but it's so ironic because the assumption is almost made of like they even call it an investment. So investment versus this investment, and then they go down to let's look at the rate of return. What's better, 3 or 8? And you're like, is Miss Rachel like obviously I'll take the 8 if that's the only options that I'm given. Okay.
Right.
So then if we take a step back, it's like, okay, then they're almost saying like, oh, we're borrowing, like we're not even making it work. They almost assume that borrowing against the contract makes the product worse. And again, what's that logic? They're literally just looking at one black box versus the other. They're not looking at the concept of velocity of money. It's like, oh no, you're telling me that you can have insurance protection, all the other benefits of life insurance that we're not shy about, and you can free up capital to then go invest in opportunities. We mentioned there's two assumptions that you could make. You could just put it in the same investments that you guys are talking about, and or you could potentially create a better opportunity because you have access to capital. So that's the whole idea of like, I don't think anyone that's endorsing infinite banking is saying, you know what you should do? You should put your money into life insurance, all your money into life insurance. Don't touch it, and that you're going to get a better outcome. There's probably people out there that teach that, but most people that talk about infinite banking are talking about using money. We could get critical there, but that is a big part of the pitch of the presentation when it comes to life insurance, and even like my book, The And Asset. And you're getting the benefits of life insurance, and you're getting the ability to utilize that capital. And while that doesn't always mean you're going to have a better outcome, that increases the ability for you to get a better outcome. And if rate of return is the problem or is the constraint, then do that. And then you can determine putting money into life insurance, borrowing against it, getting a better rate of return, taking the loan cost out, and including all the other benefits of life insurance versus just investing the difference. That's like the true apples to apples comparison. It takes time. It takes understanding why someone would get life insurance outside of just the investment. But like, those are the kind of things that like get me fired up. That's like, that is the message that we need to be hitting. Because if we don't hit that, I'm in Bo and Brian's camp all day long. Like, I agree with that.
And we hit on this. The second approach takes inductive reasoning.
Right.
The first approach is easy. It's deductive reasoning.
What's the difference between deductive and inductive?
Let's summarize it this way. If I say, well, if you put $5,000 a year and you earn 10% on your investment, you'll make it to retirement and do fine. So what am I doing? I'm saying, well, if you do this, you're going to end up with this.
Mm-hmm.
So that fits with black box financial planning. Inductive reasoning takes a backward approach and says, okay, here's where I want to end up at retirement. And it could be things like infinite banking. But I want to back up and say, okay, what are various things I could be considering to get me to that endpoint? And what are the various ramifications of each one of them? That's inductive reasoning. Now, I'm not an expert on this, but they're starting from two different vantage points. Okay?
Any other points you want to make on point number 7?
No, I think that's good enough for now. They got plenty of content.
I love it. All right, point number 8. As we're getting close to landing the plane here. Point number 8.
Well, it's a deeper dive altogether into rate of return assumptions, and you see this covered in many aspects of the insurance world. I've seen this for years: average versus what I call actual rates of return. We've done a good job of an industry educating the consumers on that. I don't think the investment world has. So if we're going to apply this in the insurance world, we also need to be applying this for full evaluation in the investment world. And the reality is there are differences, big differences in average rates of return versus geometric rate of returns, or what I call actual. An average rate of return is simply adding up all the returns you've experienced and dividing it by the number of years. That has nothing to do with how it impacted your underlying account values. And so that's a starting point. So we're going to build on that a little bit. We also want to start getting into the drag of fees and costs. Now, I'm not talking about the fees of a mutual fund company. I'm not talking necessarily just about the cost of a low-cost index fund. I'm also talking about, in this world we live in today, the push is for assets under management by investment advisors. We know that Brian and Bo are both IARs. I also am an IAR. I get paid a fee for assets under management. But we also, in a comprehensive look at everything, we have to acknowledge those fees are having an impact on a family's overall financial well-being and wealth-building capability. And so when you start factoring those in, and when you start looking at the reality of future values when they're factored in, it also starts saying, now I can start to also see where maybe these insurance products start having an impact in a positive manner. Let's disregard equity indexed universal life for a minute. There are not ongoing fees in whole life. Are there costs? Yes. And let's leave it for that right now. But you don't have the drain of fees on a whole life product.
Yeah, and that was something mentioned, and we got into it with our deeper dive on Life Insurance 101. And technically it's semantics, but if you understand actually the art of a whole life insurance product, there is no fees. And before you jump all over me, of course there's costs. And that's where I kind of was teasing you. I'm like, it sounds like you're gaslighting people, but that's why if we get in a whole conversation between IUL and whole life, that's why there's maybe a deeper conversation there. So just wanted to clarify what you meant by that. Okay, all right. Point number 9.
Point number 9, we're going to delve into a little bit the code of conduct by the CFP board and what all of us as CFP professionals have to agree to. There's all kinds of aspects to this, but one of them has to do with the code of competency. We have to agree that if there is something that's over our head, in other words, we don't have enough knowledge, we don't have enough training, we don't have enough education or experience, we need to admit that and pass that responsibility on to someone else. And perhaps I'll give a little taste teaser here because I think this might summarize it for this video better than anything. I talk about Dick Weber and him being very involved with the Society of Financial Service Professionals for decades. Dick is a consummate professional, and you'll learn more about him if you choose to dig deeper in these videos. Dick has come out and said, if a certified financial planner has not had more training specifically on life insurance, other than what they have gotten through the CFP curriculum, they should not be giving any life insurance advice.
So those are strong statements.
It is all term. I just want to make sure though that people measure twice, cut once, because a lot of times, especially with financial products, read the fine print. There's a lot more going on beyond the brochure.
Dan, as we wrap this video up, if Brian and Bo are watching this video, if other CFPs are watching this video, or if there's just other financial professionals that really want to understand this more, like they want to do right by clients. They know that putting all their money in insurance and annuities is not the solution. That's easy. They may believe or may not believe that putting all their money in a proper portfolio is the right solution. They may or may not, and they want to seek the most efficient way. What would be the resource or the place where you would encourage them to start researching? Like if you had to summarize, okay, out of all the things that I know, what is the gateway? What is the first domino that you really need to knock over to start gaining understanding of this world, of these two silos, how insurance, annuities, potentially reverse mortgages can fit into your investment portfolio and actually create greater income, greater legacy, greater certainties? If that sounds crazy, I'm telling you, that's possible. And it's not just possible, there's very, very smart academic research behind this. Where would you begin with just trying to better understand this world?
That is extremely difficult to answer.
Hey,
but let's try to tackle
That's why they pay me the big bucks.
Let's try to tackle it a little bit. I think certainly we've given you a starting point through the recordings that we've done today. Those research articles that we are going to talk about is a good place to try to at least start getting your head in the game.
If someone didn't have our video series to watch, where would you point them to?
They better get a hold of me because I can't cite them off the top of my head.
Or just is there would it be something around income efficiency? Would it be Dr. Wade Fowle's research?
Research Dr. Fowle, the Ernst & Young, I don't remember the title of it.
Right. Those, do you think it's because what you talked to me, and I think I mentioned this, is infinite banking's not for everyone. I'll be the first to say that.
Right.
But you were hey, you called it 1X planning. You're that is for everyone. And the premise of that is in incorporating and integrating insurance products and investments and creating better outcome. That was a crazy statement that you made because you're I believe everyone's financial life gets better if they understand this. If someone's interested, hey, I want to double click on that, is there a book? Is there a resource that you'd be this would be a good first start to understanding this?
Well, Bob Castellone's book would be what I would first think of. But honestly, I don't know if he covers 1X planning in his book.
Okay.
His book is heavy.
Okay.
Many of these books, they're the kind of thing you only can read 2 or 3 pages.
Yeah.
And you got to step back and say, I got to absorb this.
In the description, we will have resources that if you want to learn more and challenge even what you're saying, Dan, because you shouldn't even take what I'm saying, what Dan's saying at face value. Let's all do the research and get better. I have a ton of empathy because even when I asked you that question, it's it's hard because
it's hard.
And that's part of the issue is it's really easy to put in a financial calculator and see how much money you have and just make some basic assumptions. And to be quite honest, sometimes simplicity wins and complexity. And so over complexity. And so one of my goals is to try to create more simplicity and clarity in an approach that I believe is better but it's not better if people aren't applying it well. And
Mhm.
I think also, to be fair, because we've been talking about the benefits of insurance, I think we need to address there's a lot of negative stories and aspects of insurance. Like Kyle Busch is probably the most public recent example of someone
Yes.
who's well known, who has great resources, and that has felt and has actually been taken advantage of
Yes.
from an insurance product standpoint. And when we see that, we're like, if that could happen to Kyle, that could happen to teachers and other people. And it's not, and that's where I think it gives the profession a potential bad rat name. And with every good example of insurance being integrated properly, if we're being honest, it's a small sector. And this is not a commercial for BetterWealth. Like, we're genuinely trying to help people incorporate this well. And so if this is something that you're interested in learning more about, we'll have a link for you to connect with someone on our team about looking at your scenario and saying, does this actually make sense for your situation? But we got to figure out a way for people not to just have to go to people like me or you or other people. Like, my hope is that more planners, more people in this profession, like, we come together and we say, hey guys, like, let's agree on some things.
Mhm.
We may disagree. We'll always disagree on certain aspects, maybe to the different ratios, but can we all agree that investments and insurance should actually be brother and
Combined.
sister versus competing? With that, any final words before we land the plane?
Well, if someone wanted to study retirement income planning, I think there is one book, and that's Dr. Wade Pfau's third book on it, where he combines the risk approach and the guarantee approach. Now, that's not how he words it, but he did the first two books, and then he combined that research. A forewarning,
It's
heavy.
Yes.
Okay, but if someone wanted to immerse themselves, that's, at least from a retirement income standpoint, a good place to start.
Cool. Any final words?
It's been a blast, and I really encourage folks. There is a lot of content here that has come through, for me anyway, years of reading and research and teaching that you can take advantage of in just a few hours, that if you were to try to tackle it yourself could take years.
Yep.
So I'd encourage you to dig in.
And Dan, thank you so much for taking the time to put all this research together. This was fun as like a summary to just go
Sure.
through this, but I'm thank you for helping us with our mission of not just getting to 100,000 subscribers on YouTube, but educating this profession, helping people be better equipped. Thank you. We'll include your email down below for people to reach out if they have any additional questions. And I just want to encourage you, if this like meant a lot, reach out to Dan and let him know, because sometimes we're in our own little worlds and we don't understand that the work that we're doing is actually helping other people. And so I appreciate your time and energy.
The honor has been mine.
Thank you.
Now, I want to also just say one thing. I am approved as an outside business activity to provide education. So what I am doing here is to educate you. I am not providing financial advice.
That's right. This is not financial advice. We'll even have a
Yeah.
slide that says that. If you're going to sue someone, I guess send the letter to me. All right. Take care.